Hello, everyone. Welcome to CAPIS's edition of the monthly research briefing this month in March. That we're excited to have everyone here. We welcome new clients and friends to the call, as well as the returning members that have come to join us every month. I'm Ed O'Dowd of Capital Institutional Services, and this is part of a monthly, for anyone new, this is part of a monthly series we have where we introduce new research partners, vendors, people we have a relationship with that cover different areas of the market, have a different viewpoint in the way they look at it. And we're really excited today to have someone join us who actually joined us about 6 months ago. That's Andy Carenci of Ubineer. He's a Toronto-based investment research analyst. Has a firm there where they, have a unique way of looking at things compared to some of the other people that we've had on. Andy utilizes AI to capture information, to help him at the end of the day. He looks to be fundamental analysis is kind of how he brings it down eventually, but how he gets there is a little unique, particularly in this ever-evolving landscape that we have technology-wise. He's going to cover some of the big tech names. I'm excited to have him on. It was great last time. So good to have him back. Andy, welcome.
Ed, absolute pleasure to be here. And again, thank you so much for the awesome introduction.
Yes.
Um, I'm really excited to be talking to you guys. I think we're in a moment in time where, and we're going to talk about this, the amount of spend for artificial intelligence and capital expenditures is quite insane, and insane in a good way. And it's almost a new type of industrial revolution. That's kind of how it's referred, and I actually agree with that point of view. But before we start, I would like to kind of jump in and first describe number one, what our firm does. In short, we're an AI software company that helps institutional investors by pretty much transforming financial data into predictions. The second key pillar of what we do is we discover anomalies so that we can reduce the manual part of the research process for professional CIOs and portfolio managers. And the third kind of new product or new solution that we brought to the market is we help investors to understand if their thesis is priced in the market. And that thesis could be anything from, hey, I believe the free cash flow of a company is going to be X, to, hey, I believe the revenue growth of this company is going to slow down. And we will be discussing all that together. In short, what our true help that we provide our clients is simple. We convert their gut feelings into AI powered analytical advantage. And with that said, I want to first discuss what we're going to be chatting here. So I mentioned to you guys we're going to be talking about CapEx and AI. But more importantly than that, we are going to continue looking at what we looked at before. Number one, the 8 biggest companies in the world really matter. And so we're going to be discussing Netflix, Meta, Google, Microsoft, and Amazon. More important is last time I provided some estimates, and there's nothing better than accountability when it comes down to estimates. So we're actually going to review what we said before and what happened. And the final kind of key thing which I want to discuss is NVIDIA and the broader stock market in general, because that was one of the key questions last time that people were asking. So with that said, I'm just going to jump right into Netflix. So if you recall, the investment thesis that I gave for Netflix was relatively simple. The company increases its value by increasing how much content they have. So the content that they buy, whether it's K-pop Demon Hunters, which the songs took over the world, to if they could get the Friends franchise, and so on and so on and so on. So the content that they add into their platform really adds is one-to-one correlation with how much value they generate for the user. And once they generate that value, the key thing is how do they monetize it? And they monetize it by pretty much having users, number one, whether they're on the ad tier or on the premium tiers, and two, higher prices. And this is actually all that you relatively need to know about the top line for Netflix. And our estimates were threefold last time. One, we expected the acceleration of revenue growth to be at least 17.4% in Q3, compared to their guide at 17.3. Q4 revenue growth last year should have been higher than Q3 or stayed relatively flat. And any strategic changes on this business would come from the content element, which is how they would kind of handle what they would do with content. So let's just jump into this. So we did get one wrong. So the acceleration of revenue growth, we did see it from Q2, which we were last time, to Q3 here. The problem is it missed our kind of guidance, but as you could see, the Q4 number was above the Q3 number, which is exactly what we predicted. With that said, 1 out of 2 here, we got to be honest with ourselves. The key other element, which I mentioned, is any change to strategy would depend on what happens with their content. And they, for the first time ever, tried to make one of their biggest acquisitions ever when it came down to content. They tried to buy Warner Brothers Discoveries. Obviously, as we know, as of last month, that deal fell through. And again, if there is ever going to be a change on this business, this is what will matter. How they will acquire content, because content is the number one element of value and what they consider value. One thing which I want to say on the decline to raise their offer for Warner Brothers, I want to make it clear that they actually got a breakup fee of about $2.8 billion. Now, that might look like a very little dollar amount, but hey, just for putting a bid to get $2.8 billion, that's no joke. And we're going to dive a little bit onto it. So, what is new with Netflix? Well, in reality, not much has changed, luckily, since the deal did not go through, except from my calculation, the stock is down about 23 to 25%. Thus, the thesis still stands. Hey, the more content that they add to their platform, the more valuable it becomes, whether that content is live or whether that content is just a show that you can jump in at 7 o'clock and watch. And the key thing here that we need to discuss is what happens to the user count and what happens to the prices. And our view is the user count, give or take, have somehow, the growth rate on that has somehow plateaued. And that leaves us with the price hike. And the biggest question that I think everyone on the street is asking is, when is the next price hike for our Netflix bill? And I believe that if there's going to be a price hike for Netflix, it's going to come 5 to 7 quarters after their last one. Their last one was between Q1 and Q2 last year. So as you can imagine, we're on the 4th quarter. So we're starting to enter the yellow or the amber light, and soon the orange light, and then the red light. So within the next 2 to 3 quarters, we're going to see a price increase. I wouldn't be surprised if it even comes earlier. With that said, we want to talk also about the content spend. So as of December 31st, because that was the last time the company had presented their results, I want to show you this spike. So we discover anomalies in fundamental data using machine learning. This spike right here is how much obligations they have, streaming obligations they have. And the interesting thing here that I want to note is this spike in increase here happened even before they knew that the deal was going to fall through. So whatever new content they are starting to lock in and starting to acquire, it happened before they even were going to thinking of losing the bid for Warner Brothers. So that is something to watch, and that is how kind of Netflix also defends their market. The next thing I want to discuss is obviously Meta. Meta is the second company, and what I mentioned with Meta is the revenue growth for Meta depends on 2 things. Number one, how many ads they show you on Instagram or any of their, or Facebook, and more importantly, the price per ad. So as the price per ad and the growth of number of ads shown increases, you tend to actually get a revenue growth. And our estimates for Meta were relatively simple. Advertising revenue growth should be higher in than Q2 2025, when the last time we chatted was, and CAPEX should continue to grow as long as revenue growth is there. Both of these things came true. So on advertising revenue side, it was around 22%, and then the last 2 quarters since we last chatted, it's been close to around 25, 26%. And then CAPEX has continued growing. right? So what is, and just so you know, the numbers that I provided to you guys were actually the numbers that we shared even with our clients at that time. And we were correct on both quarters and next quarter kind of revenue growth, and more importantly, the CapEx guidance that the company was going to give. So again, I wasn't trying to provide two different viewpoints. What we share with you guys, it's what we share with our clients as well. So with that said, what really matters for Meta? And it is all about CapEx right now. Everyone's concentrated on how much money they're spending on capital expenditures. If you recall, last time I shared with you this graph, which is all obligations that Meta has entered, or contracts that Meta has entered all the way up until 2034. And at that time, the value was around $80 billion here, and it was growing at around 200%. Since then, there has been two other new quarters right here. So we were at this point. Right now, Meta's obligations, total obligations, are almost 240 billion versus 80 billion last time. So almost threefold, right? And more importantly, the growth rate has also spiked again to around 250%. So if you think that Mark Zuckerberg is going to stop the capital expenditures anytime soon, I believe the management team at Facebook will disappoint you. But we'll see what happens. So with that said, can their business model actually handle this? And the best way to describe this is actually by just looking at what's happening with their growth rate. Advertising revenue, that is the majority of their revenue, is up 20. It's up north of 25% for the last 2 quarters, and more importantly, this is the cash flow from operations. Their cash flow from operations up 26%. So they're actually increasing the leverage of how much cash they produce from their operations. And if you kind of look at here, their cash flow last year, on this is a trailing 12-month number, was around 120 billion. And this year alone, they came in at providing a CapEx guidance of, I believe, 125 billion. In other words, what Mark and the team at Meta has decided to say to the market is simple. We're going to continue investing in this thing because it is driving revenue growth for us. And we will continue investing in it until we don't see that we can squeeze any more juice. With that said, the other key element which I mentioned about Meta last time was that the glasses were going to be the new call option on the stock, and I still believe that to be true. It's just this will take a long time to play, and I mentioned to you guys some KPIs to follow there. The next company which I discussed was YouTube, Google, Alphabet. And more importantly, it wasn't, again, their investment thesis is relatively similar to Meta's if you look at this graph. But more importantly than that, what we discussed was, hey, Google had a sleeping giant that no one was looking at. And that sleeping giant was called Google Cloud. And more importantly than that, Google needed to grow their CapEx extremely quickly for them to keep up with demand. And that is exactly what the company has done. So for the first time ever, Google provided capital expenditure guidance since the beginning of time. And again, it was a surprise to kind of everyone, except maybe your listeners to our call. And they provided about 175 to 185 billion guidance as of last quarter. That was the first time that they gave a guidance for a full year CapEx number. And what I wanted to say is this is actually completely justified. So you could see the revenue growth of Google Cloud, the sleeping giant that we called last time, go from about 30% to almost 47%, all in 2 quarters. And more importantly, if you look at it on a quarter-over-quarter basis, so this delta right here was about $2.5 billion. Remember, before the ChatGPT moment, they were doing about $6 billion a quarter of revenue. So they did almost half of that, 40% of that, just in new revenue this quarter. With that said, the new thing about Alphabet is they're still playing catch up, and they're playing catch up because of remaining performance obligations. their customers are signing longer and longer deals with them. And you could see that over the last year, their remaining performance obligations has went from sub 100 billion all the way to almost 250 billion dollars. And all of this happened the last 2 quarters since I kind of flagged it to you guys. And this is a big, like, this is an incredible opportunity for this company, and thus does require more capital expenditures, and hence why the management team said that they were going to put more money into it. So the other key element is, as you can see right here, similar to Meta, it seems like the message is clear. We're going to spend roughly what our free cash flow, this is the trailing 12 month, roughly what our cash from operations last year was. We're going to spend it in CAPEX this year. That's how much of a catch up they're playing to make sure that they continue having higher revenue growth, because they already signed the commitments. They just have to figure out how to deliver them by building data centers. Okay, next up, Microsoft. This one's a little bit more interesting. Revenue growth for Microsoft, as I mentioned last time, depended on seat count, continuing cloud and AI spend, and more importantly, upgrading customers. And our view on it was, hey, Microsoft needs to continue to feed the cloud, and more importantly, upgrade customers. So it's this element, and this element is what matters most. And that is exactly what they've done. They've continued feeding the cloud, and as you can see, their revenue growth from last time has actually been higher than it was before, to almost 39%. And then it all comes down to upgrading customers. And if you saw a most recent press release from them, they're starting to convert M365 E5 users, so that's probably what the majority of kind of banking people have, from a $60 license seat to about a $99. They call it the E7 model. Again, it's upsell. That is the name of the game. They've got, seat count is not growing. If anything, we think it might be slightly declining. So with that said, what is new with Microsoft? The key right now that everyone's worried about is the seat count number. And everyone's worrying about it because they think that AI, in short, will reduce how many people get employed by companies. We actually think that as of right now, we do not see this question mark still being there. What we do know for a fact is that M365, which is part of their productivity and business line, there's no seasonal pattern change here, especially over the last year, but it's still to be determined. More importantly, the upgrade cycle relatively ended as of 6/30. So overall, this is kind of seasonal for them. So overall, they're actually, we don't see that full seat count pressure. But what is clear is, you got to continue feeding your cloud and AI spend, because this is the spike of how much more demand. So they're at about $25 billion of demand that's out there that they can't meet. In other words, contracts that they've signed that they have to figure out how to close. And again, same thing with kind of Microsoft. Their trailing 12-month cash flow from operations is about $160 billion. And as you can imagine, that is give or take what they're going to say that their capital expenditure needs to be, roughly speaking, for calendar year 2026. And that is actually the name of the game that everyone's currently playing. As if they've already communicated with each other saying, hey, this is how I'm thinking about this problem and this is how I'm solving it. Amazon, I mentioned to you guys, world e-commerce is the key driver for revenue growth. That was our investment thesis. And more importantly, cloud and AI spend really matters for them. And again, what we said last time is e-commerce will continue to grow as a % of spend. AWS will continue to grow and is limited by CAPEX. Those exact things happen. So as you can see, growth rate has stabilized for their e-commerce business. That's over here. And more importantly, on AWS year-over-year revenue, we're starting to see that continued growth here. And you can see on a year-over-year basis, since the last time we discussed, their revenue growth has continued to grow. and even their growth rate is accelerating here. So what is, and to be honest, the key thing which we were trying to do last quarter with our clients was what's going to happen with their free cash flow. We were able to predict the free cash flow pretty much bang on. And more importantly than that, we were one of the only ones saying that free cash flow for the year for this company was going to be negative. For FY 2026, they came out with a massive CAPEX guidance, and now everyone is starting to assume that too. But again, is it justified for Amazon to do this? And we actually genuinely believe so, especially when you look at their growth rate of their remaining performance obligations or the contracts that they've already signed. As you can see, it jumped in one quarter from close to 20% to almost 40%. Again, all this stuff is justified because there's contracts behind them. With that said, the key element which we want to look at also is what's happening with their cash flow from operations. As you can see, it continues to grow. It's almost at about $140 billion for this guys. Moving on, and this is where accountability becomes a key element to us. We were wrong on one out of this 11 kind of key predictions on this companies that I shared with you guys, and that actually matches, give or take, roughly what we do for our clients. Except we did a little bit better here together. So, with that said, I want to discuss NVIDIA. This is the largest company in the world, and I believe will continue being the largest company in the world for quite some time. And the reason for it ties extremely well with kind of what we've been discussing over the last little bit, which is AI CapEx spend. AI CapEx spend, as you can imagine, is growing, and we'll get to look at those numbers. But more importantly, there's a bit of an NVIDIA tax, if you want to call it, or an NVIDIA tariff, whichever way you want to take it. And the key here is the data center revenue that most of these customers kind of need comes from NVIDIA. They're the number one provider of everything. And just for 2026, the estimates that everyone's providing is pretty much what I described before, which was their cash flow from operations from last year. So Amazon's going to do about 200 billion, Microsoft 150 billion, Oracle 50, Alphabet 180, Meta 125, other neoclouds, this are the smaller data center providers, about 45 billion. And this is just North American companies alone. This does not include, for example, China, the Alibaba cloud, the Tencent cloud, or any of those in the market. So anyways, the growth rate, last year it was about 443 billion. This year we're at around 755 billion. So as you can see, that's pretty massive spike. And one good rule of thumb is between 40% to 50% of this actually goes straight to NVIDIA. And depending on if they're buying land this time, or are they buying the shell, which is the building, or are they actually feeding it with servers and GPUs from NVIDIA. With that said, their data center revenue, this is the true kind of American story of resilience. This moment right here is the ChatGPT moment. Since then, it's went from sub 20 billion to almost $200 billion this year in revenue, the data center alone. Again, I don't think this has ever been done before, this type of growth and this type of speed. With that said, maybe a couple of weeks ago, Jensen came on stage and said, hey, last year I said to you I had about $500 billion booked already. Right now I have close to $1 trillion booked. Right? So he's not even talking about billions anymore. He's talking about trillions. That's the speed which he's thinking of. And thus, let's assume you agree with him that he's going to be right, or if anything, he's going to be a little bit conservative. The key thing that matters for NVIDIA is what is its greatest risk. And aside from war with Taiwan and China, the biggest risk for NVIDIA has to do with whether they can actually get the supply up and running, i.e. their supply chain. And we actually believe that they have achieved that. So as of last quarter, even though they had a monster quarter, their inventory levels have gone up. Sorry, and more importantly than their inventories levels, like they grew almost 100% year over year. Their inventory levels to about $20 billion, and additionally, their purchase obligations. So how much they've bought of all their suppliers spiked about 111% to almost 95 billion dollars. So they have $95 billion of supply that they've bought as of January 25th, 2026. So we actually think that they figured out this problem because they've already bought up that whole supply chain. Um, with that said, I believe right now the $1 trillion question in the market is why are this magnificent eight struggling or lagging other markets? Whether you look at the European markets or any of the Asian markets, it seems like things are stalling. I actually don't believe it has anything to do with wars or any of that stuff. What I genuinely believe is that all this big eight are currently the spenders in the market. And thus, so if they're spending $755 billion, there's other people who will be the receivers of this. They tend to be, the component makers, whether they're in China, Taiwan, or anywhere in the Asia. It's also the IP providers. So, for example, the guys who make, for examples, cables like a Fabrinet, etc., of the world, and so on and so on. So it's just because these guys over the last decades were accumulating cash, printing cash, right? Now they're spending it. The opportunity has shifted slightly, which means that the market will start becoming a little bit more broader than just more focused, just because these guys are spending at this kind of clip. And the other key element is I'm not sure that the market does believe that their future free cash flow is actually as guaranteed as the companies suggest. And so our team went on a mission. We actually created a special product just for this. And just to prove this exact element. So what we did, I think you're going to find this kind of interesting, is we created about 100 different AI agents. All of these AI agents are pretty much at your call, but they're properly grounded on what blogs the company provided, what SEC filings were filed on behalf of the company, what keynote speaks have they said, what do the opposite side of the market think, so what do their suppliers say about them, and so on and so on and so on. And the key idea here is if we spin up 100 potential investors, which look exactly like their 100 biggest holders of their company, what would they all say? And here's an example, and this is with Meta. If you were to ask kind of what do all this 100 AI agents say about Meta's free cash flow, what you will notice is all of them have different viewpoints, and there's no standard point of view between them. Some expect positive free cash flow, some expect negative. And this was for FY 2026, which is this year. What about next year? And again, there's still no clustering happening here. And thus, I believe that the market right now, and our technology has shown that no one, specifically all these different AI agents, which are, think of them as a digital twin of the actual stock market participants, they're all struggling to figure out where we are in terms of the magnificent eight free cash flow over the next couple of years. So that is, I think, the biggest question in the market right now, and that is the biggest reason why these companies are lagging. With that said, I want to open it up to Q&A, and I look forward to hearing from you guys.
Absolutely. Thank you, Andy. That was a great presentation. If anyone has any questions, just put it right into the chat at the bottom of the screen, and I will read it out loud for everyone to hear. I had a question though. Of all the companies you just mentioned, what do you think, which one has the most strategic challenges going forward in this
I
market?
think that's a really good question. I would start with on the messaging side, it will be Microsoft, especially on the seat count problem that I mentioned. The second one is Meta. I think Meta will have a little bit of trouble explaining if their revenue growth, for example, starts slowing down. Meta will have to somehow convince the market on, hey, what we're doing with this capital expenditure spend, it's not just building large language models. We're using them internally. We're productizing them, etc., etc. So they'll have a little bit of a challenge there. And actually, here's a little bit of a dark horse. For me, I think Google, the majority of what's happening with Google is give or take priced in. So if you remember last time, the key thing which I was saying is, hey, there's something happening with Google. Everyone's missing this Google Cloud component. And then the growth came for that Google Cloud component. So the question is, what is the next act from Google? They also became, as you know, like the best frontier model for a time. Now they're kind of battling it. But again, they pushed the boundaries so the key is Google might be at risk because everyone kind of understands the business there. So I hope I answered that question well.
Yeah, you definitely did. Can I ask about Oracle? What do you
Yeah,
there?
it's a great question. So I actually am contrary to what most people think. Everyone thinks that we're in a bubble. I actually believe we're in the earliest stages of any bubble, and the reason for this has to do with free cash flow, with the cash flow from operations. So as I mentioned to you guys, hey, these companies are pretty much spending the cash flow from operations on this thing. On the Oracle side, if the key thing which I think everyone should look at is the remaining performance obligations versus their purchase obligations with respect to Oracle. And what is clear is that Oracle is starting, so any data center capacity that they have is starting to monetize it, and it's actually starting to hit their cash flow from operations. So I highly recommend people spend a lot of time looking at them. I know that there's a bit of risk with respect because they don't have the balance sheet that obviously the Microsofts of the world have, or the Amazons of the world, or the Googles of the world, and the Metas of the world. But what I believe happened here was NVIDIA wanted to create a new favorite client or hyperscaler, and because they controlled the supply, they were able to provide it to the oracles of the world. So in a way, NVIDIA de-risked their model by creating competitors to the hyperscalers with their supply. So
Okay.
there's a bit of an NVIDIA nugget there too, because everyone plays this game, right? So with one good person getting some allocation, others don't. So there's a bit of like a back and forth game happening here.
All right, thank you for that. I have
Yeah.
a question from someone on the call. Do you think the recent court outcomes against Meta and Google will have long-term negative pressure on Google and Meta? Will this show up in your models? I guess it
Sorry,
was
one
a
more
court. I
time.
guess it was a court case. I guess against over social media harm to
Oh
children.
yes,
Okay.
I did read that. So that was as of I think that was a news article as of yesterday. If you saw the penalization there, it was almost like it's like a couple of minutes of their revenue on a per
Okay.
quarter basis. The key thing here is these companies are riding one of the greatest super cycles, and we're in the early stages of it. The key thing which matters for both of these companies is how much attention people are spending on their platform. So how much time people are spending on YouTube, how much time people are spending on searching on Google, how much time they're spending on Instagram, how much time they're spending on Threads and Facebook. I think if we start seeing any weakness there, that is when these companies will get challenged. Anything before that, all the court cases. So, for example, there's been like Brazilian court cases against Netflix, which happened since the last time we chatted. None of that changed the investment thesis for these companies, in my viewpoint, obviously. But so thus, I'm not too worried about it.
Let me ask you. So you say you're bullish, and I like that. We're not in a bubble, but we're in the early stages. So with that said, what do these companies, these Mag 7, Mag 8 companies need to do to gain the trust of the market going forward?
Um, Continue showing. So the reason why I focused on cash flow from operations and free cash flow was was because of this exact key point which you hit on, is they need to continue to show that this stuff is not them just giving credits to people to use their cloud. This is actually driven by revenue coming in and, more importantly, cash in the end. So, in other words, the customers are paying for this. That is the key problem that everyone's having right now. Is, hey, is can OpenAI afford this? That was the biggest question, kind of towards the end of the year. I
Hmm.
actually believe that OpenAI and Anthropic can definitely afford this, and more importantly than that, actually in about probably by the end of this year, people are going to actually think that Sam Altman was a genius because he secured so much compute. It hasn't played out yet, but I think by the end of the year, everyone's going to think of OpenAI as one of the key winners here because they secured all this compute. So yeah, the key thing which everyone has to look at is cash flow from operations, and if these companies are continuing, if that is continuing to grow. Obviously, there's some seasonality for some of these companies, but if you look at the trailing 12 months, that is your key metric that you got to follow.
All right, thank you.
Thank you.
Again, any more questions? I think that's about it from the audience. But Andy, thank
Awesome.
you so much. That was a
And
fantastic presentation. I
it
enjoyed
was
it.
an absolute pleasure, and thank you guys so much for having me. And I wish everyone a wonderful day, and see you guys extremely soon for sure.
Absolutely. We look forward to that. For everyone on the call, thank you for joining us today. Really appreciate it. Next month, I think April 16th, we're going to have Markets Policy Partners back. And as regular attendees of our calls know, it's more macroeconomic, and they look at the political environment. And I think with the Iran war, we'll have a lot to talk about with them. They'll look at interest rates and all that. So again, that's going to be April 16th, Thursday. So we'll look
Okay.
forward to seeing you then.
See you
Thanks
guys.
everyone for joining us. Appreciate it. Andy, thank you so much. Have a
Absolute
great
pleasure,
day.
Ed. Thank you.